Becky.
Andrew, thank you. We are here at the Chevron Leadership Initiative's Co-Mission Champions of Women in Sport event. Joining us right now is Goldman Sachs CEO David Solomon. He's here because Goldman Sachs has an interest in women's sports and in the LPGA in particular. But Dave, I want to talk to you about what's happening in the markets right now. It's been a pretty confusing time. You're seeing all these weird things happening with equities dropping, bond yields going up, the dollar dropping pretty steadily, gold prices at all-time highs. And it's making people wonder what this all means. Is this a crisis of confidence in our markets right now? What do you read as to what we're seeing?
Well, first of all, thank you for having me, and it's good to be with you.
Thank you for joining us.
Absolutely, it's good to be with you in Houston. We're in a very different macro environment than we were in just a few months ago. I think the last time I was on the show and the last time I spoke to you guys was in Davos, and certainly we could all talk about kind of the aura of how people felt in Davos, but it was very, very different. You were coming into the inauguration. There was a lot of optimism around a lower regulatory environment and changes, and so now we're a few months into the administration, and instead of policy becoming more certain, we actually have a greater sense of uncertainty broadly, and it's having a big impact on asset prices and markets. And so the trade policy and the discussions about trade policy certainly have changed the level of uncertainty in markets. Markets are looking to reprice the value of things based on the uncertainty they have around what these policies will ultimately look like and how they will ultimately be implemented. And that is therefore causing shifts in fund flows on a very significant basis. And I think one of the things that's different about what we're seeing right now is normally when asset prices, when equities reprice, it's not surprising when you go into a more uncertain environment that equities reprice. Mm-hmm. But generally when they do, people buy U.S. Treasuries. But here we're seeing different behavior because at the margin, people that have been very, very inclined towards U.S. dollar assets are slightly shifting their preferences. And I'd say it's still at the margin, but as people are selling equities, that puts downward pressure on the dollar, given these are all U.S. equities. You've got investors around the world buying U.S. equities. And as they de-risk to some degree, that's putting pressure on the dollar. And that obviously has an impact on treasuries. So the level of uncertainty is high. I think it's good that there's been a delay, let's say, in the implementation of these reciprocal tariffs. But we still don't know what these deals are going to look like, where it's going to land, and what the ultimate impact on business will be. And so what's happening is business is pulling back. People are pulling back because they want to wait and see. They want a higher level of certainty before they make decisions and they move forward.
So you think this delay is good? You think it's good because it gives it a chance for them to undo some of those actions and activities?
I would say the delay is good because this was all happening very, very quickly. And, I think these are complicated issues and we need more time to see what the ultimate result will be. I think one of the things about the delay is the delay didn't decrease the level of uncertainty. In fact, in some ways, the delay increased the level of uncertainty. And so until businesses and individuals all over the world, not just here in the United States, can understand our trade policy, how it's going to be implemented, and that allows people to step back and make decisions about their capital spending, their investment, their planning. We can understand relationships in global markets with respect to the dollar. Until we settle down and get to a place that you can understand that, we're going to see a higher level of volatility and continued pressure on U.S. asset prices.
So you say this is around the margins, just in terms of investors having less faith in the United States and other places. Do you think that this, because some people get hyperbolic about this and think that this is the end of the American exceptionalism when it comes to the markets. Do you think that's the case?
Well, I've been talking to clients all over the world, and I happened to be on a trip, overseas last week. I was in the Middle East a little bit last week, and the reason I say at the margin is kind of U.S. preeminence from an investment perspective and the long-term flow of international investors into U.S. assets because of the relative performance of the U.S. is something that's happened over a very long period of time. And you can't reverse it 100% in 5 minutes. And so what we're seeing is certain changes in behavior at the margin. But when you step back and you ask, what are the opportunities? Where can you go? Think about it as a balance in a portfolio. If you've got more U.S. dollar exposure, there are two ways that your portfolio rebalances and you have less U.S. dollar exposure. Right. One of them is you can sell the assets. The other is the relationship between, let's say you're a European investor, the relationship between the dollar and the euro changes. So I don't think that we're taking 80 years of a direction of travel and just reversing it instantaneously. But I do think these are serious things that you have to watch very, very carefully. And if we don't get to a policy place of certainty where people can trust and they can rely, it will have longer-term implications.
But what I guess what is the alternative? Where people go?
Well, that's one of the things as I listen to clients and I talk to clients that are big capital allocators around the world. And we happened to have a conference in the Middle East last week where we had both, capital allocators from that region, but also a bunch of U.S. capital allocators come together. And when you step back and you look at the big buckets, the big opportunity buckets, whether it's the U.S., whether it's, broadly across Europe, whether it's China, still, even with all the issues that we're facing here, when you look at the innovation economy in the U.S., you look at what we're capable of from that perspective, you look at our capital markets, our capital formation, our financial system, we have enormous embedded advantages that I think investors around the world recognize, but they're concerned by the level of uncertainty. They're concerned by the pace of change, and they're looking for more clarity as to how this will settle down.
And the tariffs in themselves, where do you think things will settle down? If markets are reacting and trying to reprice to whatever that ultimate place is going to be, what do you think ultimately happens with tariffs?
Well, I'm watching as you're watching. I think the administration has been clear they want a base level of tariffs to stay in place. But I think it would be very helpful. My understanding is there are a number of discussions going on with various nations. It would be good to see a deal or two put forward so there's a construct that people can understand and people can start to say, okay, if that's what these deals are going to look like, this is a framework that we can start to think about and we can start to plan as we look forward.
If you had framework like that was put out with some of these deals, where are the equities markets priced to those deals? Would there be relief in the equity markets at this point? Would it?
I'm not a good speculator as to ups and downs in equity markets, but the one thing I know for sure, if you can create a roadmap and a clear understanding as to where we're going and what the desired result is, confidence, will improve, will improve equity market prices.
David.
And markets tend to overreact in the short term. We've all been through, stress. In markets, they overreact, but you get to a different place when you look forward 6, 12, 18 months. You get to a different place where the market has digested that change in the macro environment. It will be no different here.
David, Joe has a question as well. Joe?
Sure.
Dave, I just wonder, in terms of tariffs, we're told that they're inflationary and they could be recessionary. I mean, it's like the worst of both worlds, theoretically. Now, we don't know the uncertainty of the 90 days. You point that out. But if we don't see them totally implemented on the inflation side, isn't it more likely that the real risk is that it's going to be a growth problem and that we're going to see slowing of growth, and therefore maybe the Fed can you make the case the Fed should preemptively start easing? Are they easing enough by lessening the tightening, or do you think they should actually cut sooner rather than later?
Well, Joe, you're raising the right point. I wouldn't say that the tariffs are recessionary, but there's no question the trade policy that's been articulated, or the direction of travel, has changed the perspective on forward growth. So consensus on forward growth was 2%. It's obviously much lower now. Mm-hmm. I don't know whether at the moment we're growing 1%, 0.5, 0, but growth has slowed. And part of this is it's a little bit of a self-fulfilling cycle. If confidence comes down, people obviously pull in, and that slows spending, that slows investment, and it slows growth. And so, certainly there's inflationary pressure to the degree tariffs are put in place. We're now in an environment with slower growth. Those are kind of contradictory forces that ultimately the Fed will have to deal with. The market at the moment is telling you, given the actions that have been taken, that they expect the Fed to cut during the course of the year. And to the degree that the economy really is slowing down, I do think ultimately there's a good chance you'll see the Fed, wrestle with that and try to create some sort of support for that slowing economy. But if you have inflationary pressure, that makes their job much more difficult.
Do we, though? I don't know if we do. That's my. I think one risk is much higher than the other. And as crazy as President Trump seems at times, I fear that you're going to look back and say, he was right again. That probably Powell should have cut earlier.
Well, I think we're gonna see. We have very little data. I woke up this morning, was watching the show. You have a handful of companies reporting earnings. At the moment, everybody's reporting earnings from the first quarter. You look at our earnings in the first quarter, it was reflective of an environment. We're now in a different environment. And so, Joe, until you have more data and more information, it's hard to, and this is one of the things I think about the Fed is very data dependent. Until you have more data and more information, it's hard to understand exactly where this will go.
Right.
Hey, David, Andrew, I'll get 1 second, just one follow-up real quickly. What you're saying, we're in a different environment right now. What have you seen the last couple of weeks, just in terms of the activity you've seen from your clients, the potential for deals out there? What is that telling you? Describe this new environment?
Sure. I think there's a high level of uncertainty. There's no question that capital markets activity is slower, but it's not zero. The first quarter was a reasonable quarter for capital markets and M&A. As we enter the second quarter, it's slower. We're early in the quarter, but it's not zero. We were involved in a significant deal, for WorldPay and FIS last week. It was a very significant deal. That deal moved forward. I think we're involved in a deal for Versace, which was, another deal. So there's activity. But to the degree that the uncertainty increases from here, there's no question that will slow down, that deal flow and that capital markets activity more. To the degree that we start to see some trade deals and we start to see a roadmap to the direction of travel, there's a lot of pent-up capital markets activity, and, I think that will come forward. And so, again, you need, everybody wants to jump to the conclusion. I understand why people want to jump to the conclusion, but it's hard to jump to the conclusion based on where we are at this moment.
Andrew?
David, I want you to put your investment banker hat on. Be the advisor for a moment. So I'm President Trump. I'm hiring you, David, and Goldman Sachs. I'm hiring both of you collectively to advise me on how to negotiate this deal, right? This is what you guys get hired to do constantly by CEOs who want your advice and want to understand where the leverage points are in these negotiations, how to best negotiate these tariffs. Do you do them ad hoc, one at a time? Do you try to do some collectively? The reason I ask is because I think there is a major leverage question, which is to say that if you try to actually knock off a couple of deals early, those early countries actually oddly have leverage over you, which is to say that you're going to probably give them maybe better terms then. But then it actually makes it harder over time because everybody knows that that there's going to be like a favored nation status situation going on, and nobody else is going to come to the table in the same way. The other question is, to the extent that the ultimate goal is to be able to have real leverage over China, you need a lot of these countries to get together with you. And so if you're Mark Carney, it's not clear to me from a leverage perspective that he sits around and says, how much can I give you, dear President Trump? It may be, how much can you give me if you want me to help you with China?
Was that a question, Andrew?
I want to know what you would do, how you would go about all this, given what you understand about negotiating and leverage.
So, Andrew, as you know, I was an investment banker. I'm not a trade negotiator, but I do think these are relationships. They have different contexts. The relationships between different nations are different. These have to be negotiated one at a time. But I think the important thing is to set out a roadmap of priorities. What are we trying to accomplish? What are we trying to get done? And then this is going to take time. You're going to have to, each trade deal, if you're negotiating with all these different nations, each trade deal is a one-off negotiation ultimately, and that's going to take quite a bit of time to execute on.
David, let me ask you about the markets right now, just the plumbing, because it felt like a couple of weeks ago we were getting to a point where there were some real concerns being raised, just the bond market in particular, the way it was reacting, and people can look and say, okay, that was some hedge funds that were settling some trades that had to sell some of their most liquid assets. Do you see any problems in the plumbing?
The plumbing. I mean, this is something that the bank CEOs have been talking about. Certainly, have been in touch with the Fed. I've been in touch with regulators, et cetera. The plumbing has been, markets are working quite well. Now, people don't like when stocks go down, but markets have been working quite well. I think the change in exposure that came down in March when people de-risked a little bit, I think helped as we came into this. One of the things that's just interesting to me, there's been a move in credit spreads, at this point from what I'd say was kind of all-time tights. But we're still, if you look at, high yield credit spreads yesterday, they're still tighter than kind of, 10-year averages. And so credit spreads have held in nicely. That's something to watch if the economy does indeed slow. But at the moment, markets are functioning, very, very smoothly. I do think you want to watch, the Treasury market, and that's not because of the functioning of it. That's because of the fact that we need to finance, our debt deficit. And so, obviously pressure on that has broader implications in the context of how we finance our debt and deficit. But that's not the plumbing and the efficiency of markets at this point. This is a stressful time, but in terms of market function, this is in no way a crisis.
What do you think in terms of the Trump administration? You talked about in Davos how everybody was coming into this thinking this was going to be a much more business-friendly administration. It hasn't worked out exactly the way a lot of people have planned on this, but is this a more business-friendly administration? What's your relationship?
Well, the question, you ask the question and it obviously immediately gets to a comparison.
Right.
And so the expectation was, because the last administration was very, very difficult for business, very, very difficult to engage and to communicate broadly across, all industries. The expectation was that this would be improved. I think one of the things, and I've said this publicly a number of times, the administration and, people across the administration are engaged with the business community. That's constructive. There are certain things that have been put forward from a policy perspective that, that don't feel in line with the expectation people had, but obviously we'll have to watch and see how the policy is implemented, watch and see how some of the stuff with the FTC plays out. Yeah. But it's early days, and certainly it's hard to know exactly where that lands. I don't really think about administrations as being business friendly or not business friendly. Ultimately, the economy, growth, and investment needs interaction between government and business. It's very, very important for economic growth, broadly. And so, hopefully that'll continue to be very constructive.
Joe?
Yeah, David, I just trying to figure out how to phrase this, because I certainly don't want to be Pollyannish or cheerlead anyone who's close to retirement. This is gut-wrenching, obviously, when you have close to a bear market in some of the major averages, and actually do have one in some. But is there, in your view, is there a half-full way to view any of this? I mean, the market, would you say that, 7 stocks led that market up 20% 2 straight years to highs. I don't know whether any of this was destined to happen. Anyway, we need corrections occasionally. Is any of it cathartic? And if we do, maybe not go scorched earth on tariffs, but if we go selectively and get some deals done, is it possible we're in a good place a year from now? Because there's so much pessimism now. People are writing off the next 4 years before that we're done with the first 100 days in terms of the economic record. Are you optimistic at all?
Well, I'm definitely optimistic when you step back and you take a broader view, Joe, because I continue to have enormous confidence in the U.S., the innovation in our economy, the forward on technology. When I look at what's going on with AI and the ability to deploy it in the enterprise and create massive productivity, across business broadly, massive productivity in our economy. When I look at the impacts that it can have around healthcare and health and wellness, these benefits, these are things to be enormously excited about. And so we had an extraordinary equity market, and as you point out, 7 stocks led the way. It's not surprising that something has rebalanced that. I did not necessarily expect it to be this in the form that it is, but certainly, and we did talk about this when we were in Davos, we talked about the robustness of the equity markets. And, it's interesting to go back and kind of look at a basket of stocks and where they were 12 months ago. Obviously, the Magnificent Seven and that NASDAQ-led rally has certainly, had a dramatic move.
Right.
But at the same point, there are lots of companies and stocks are up, versus where they were.
Goldman Sachs is up about 85% from a year ago.
A year ago. So, all this has to be put in perspective. Right. I think the level of uncertainty is too high. Okay, it's not productive, and it's important that we have a clear understanding of the direction of travel as soon as we can, so that businesses can plan, make investments, continue to help drive our economy forward. And
have you heard any CEOs, David, say? This is what we're hearing, that they had the rug pulled out from under them, and I think it's implied they'd actually go back if they voted for Trump and want to change their vote to Kamala Harris. Do you know any CEOs that say they missed the Biden administration in terms of their approach to business?
I think, Joe, what I'm hearing from CEOs, from clients that I'm talking to, is they want to understand, they want to have more certainty with respect to what the policy is going to look like, where it's going to land, what deals are going to look like, so they understand the lay of the road, the lay of the land, and they can make adjustments if necessary in the way they run their businesses. You can't change these things. When you look at supply chains, when you look at where things are made, when you look at how these supply chains work, you can't change them in 5 minutes or 5 months.
There was a question in there, David. You ask Andrew if there actually was a question in there, but you didn't answer the question. Do you know, are there a lot of CEOs saying, God, I sure wish I voted for Kamala, or I wish it was the Biden administration policies on business? Are we there yet? I don't think we're there
Joe,
yet.
when I'm talking to CEOs, we're talking about policy, we're talking about investment, we're not talking about people's election preferences.
All right. I'm not. You're not just worried about saying the wrong thing and incurring the wrath of President Trump at this point, are you, David?
No, I think I've been clear. We need a higher level. We need a higher level of policy uncertainty. This level of uncertainty is not good. It's not healthy, and it's affecting investment, spending, and planning, and that will have an effect on growth in the economy. And we will see that, in my opinion, relatively quickly if we can't get to a higher level of certainty around this trade policy.
David, let me ask you about why you're here. Goldman Sachs' interest in women's sports, in the LPGA in particular.
Well, we've had a relationship with Nelly Korda for a number of years, and I just must say, besides being an extraordinary golfer, she's an extraordinary human being.
She won this tournament last year.
She won the tournament last year, and she was honored last night at a dinner, as they do every year. And so we were both there for that. But there's an event this morning. I think women's sports is fascinating. Look, I come to it first from a personal perspective that I have 2 daughters. And I watch them and the impact sports had, on them and their personal development and their growth. But I also look at some of the superstars we have developing in women's sports, Nelly being one, Caitlin Clark being another. There's a lot of opportunity for growth and, interesting economics, in women's sports.
That's what I want to get to, the business proposition for this.
Well, the business proposition is very, very strong, and it's moving. If you look at the WNBA media rights deal, if you look at the
what was that, $100 million over the course of 6 years, I think, that was for Unrivaled.
Yeah,
that was for Unrivaled, $2.2 billion.
$2.2 billion. If you look at the salary cap structure in the WNBA, it's going to get a big move with this media rights deal. Now, obviously, these brands, these franchises, they're not, 50, 100 years old, and they're still developing, but they're attracting more attention. I think the direction of travel is certainly, pretty obvious with respect to that. You're seeing more and more investors taking a look and saying, hey, look at the relative value equation here. Look at the direction of travel. Look at the way the expansion of media rights can impact this. There's a good opportunity here around a variety of sports to get involved. And so we've got, a number of clients that are looking at women's sports in a completely different way than they did just 2-3 years ago.
All right. David Solomon. David, thank you very much for spending time with us this morning.
My pleasure. Thank you for having me always. I always like being with you, Andrew, and Joe, and appreciate the opportunity to be here with you, Becky.
You've got an open seat anytime. Come join us at the NASDAQ.
I appreciate it. Thank you.
Thank you, David.
Thanks. And we hope you still
Thank you, guys. Good to see you.
Yes, I feel better. Thank you, David. Coming up, Education Secretary Linda McMahon on cost cutting, restarting some student loan collections, and freezing funds for Harvard. She joins us at 8:10. Really? Because it's 8:08. Squawk Box returns in just a moment.